back at his normally scheduled time is Tech Trader. So I'm going to welcome in Sean Udell. How are you today, sir?
I'm good. How are you doing?
I'm doing quite well. Well, a week has passed, my man, and we are right in the pretty much the same exact place we were when we last spoke in the NASDAQ. So have we hit a tipping point? Maybe some resistance right along these levels or so? What's your overall takeaway before we get into a deeper dive into some of these stocks?
Well, kind of what we said last week. I think we're very, very close to, a multi-100 point NASDAQ sell-off. Don't know if it's going to hurt everything, but I mean, again, we've had a few canaries in the coal mine. Netflix was almost 400, 308 right now. Former Fang, Darling, I think we talked about Netflix. I think we're pretty clear on look, it's not a for sure short, but it's certainly not a long. And, it's almost $80 lower. And the biggest thing I was looking at is really, if you hadn't, if you love the stock, it hasn't done anything pretty much since, January 16th. So for a love stock to basically spend most of the time being flat this year, I'd rather find a stock that had gotten beaten up or is down a lot on news. A stock that's a much loved kind of momentum favorite that basically hasn't made any headway since January 16th. That's probably not a good sign. So, I actually think I don't want to spend a ton of time talking about Netflix, but I think it's worth talking about it to this point. Sometimes these love stocks, which people have a lot of faith in, simply based on stock price. So in other words, they conflate a high stock price with a quality company or even a great company. And just like they conflate a low stock price with a bad company, usually those things don't really matter. What matters is great companies are determined by, are they really great companies? Have they justified being a great company based on revenue, cash flow, earnings, market share growth? In some of those ways, Netflix has been stellar. In other ways, it's kind of dicey. They're still not much of a free cash flow generator. But I think people are waking up to the fact that this could be a very dangerous stock, and it does sometimes take people 80 points to wake up to things like this. But what does a Netflix look like with no Disney content? What does a Netflix look like with no Marvel content? I think the Marvel universe, in my estimation, has been the single greatest book of content that has kept subscribers and driven subscribers to Netflix. The fact that you can watch the Marvel movies and the TV shows and all that kind of stuff for a very, very cheap price. I think that was the single greatest coup probably that they made from a content standpoint. Well, guess what? They're losing it. And really, Netflix is just a huge kind of B movie gathering ground and B TV series gathering ground. And yes, there's good content on it, but I would say, and I've had this view for probably a year or more, I actually think Hulu has better content right now. There's certainly less bad content on Hulu. So you don't have to look through, a cornucopia of crappy content to find something that's good. And again, Disney is either the majority owner or the whole owner or something. You're gonna have all that Disney content migrating to Hulu. This could be a massive game changer. Hulu literally, might have just done the checkmate on Netflix long term. We'll see. But, it's very, very hard to justify the price here. I think it's going to act a lot like Tesla, by the way. I was very negative on Tesla pretty much, for a couple years now. Didn't quite get cut in half, but basically went from 400 to 250. Buyers showed up at 250. We'll see if Tesla eventually goes a lot lower than that. I think it could. But, same thing with Netflix. You probably got risk down to 250. And then, you probably get the value growth buyers kind of say, oh my God, it's so dumb. Netflix is at 250. It probably bounces from there. But I don't know. I can't. I love growth stocks. I especially love growth stocks when they get cheap. This has never been one, hey, I love Twilio at certain prices. I love OKTA, love Nutanix. We kind of like it again. I mean, hey, I've been all over a bunch of growth stocks, and most of them have done way better than Netflix has done. So, I just don't really see where this fits in. And if Netflix has to become, we all know what happens to growth stocks when they're not strong growers anymore. They get real ugly. And then Netflix doesn't have, Apple, it was easy transition for Apple when it said, okay, we're no longer a growth stock, but we're the greatest value stock in the world. Well, they were. Nobody had a better balance sheet. Nobody, it was trading at 2.5 times cash in 2013. You had the greatest cash flow generating company in the world. Even when sales had zero growth, earnings were super good. So in other words, you instantly could basically pull in all the value buyers of the world into Apple. Netflix doesn't have that characteristic. Google, by the way, has that too. So if the growth slows down at Google, you can just say, hey, it's one of the best value stocks out there, especially at the right price, 800 or something. Netflix, I mean, where would it become a value? Like, what would they have to do to produce a lot of cash flow? So, this is a troubling thing because they can't just fall back on the fact that, oh, we've dropped 50%, so now we're a great value. It might not be a great value. So anyway, not to spend too much time on it, but it's kind of worth a little discussion because when a stock doesn't have a lot to go on besides a hot stock price, these things can get dicey. And they a lot of times they can drop a lot more than people think. So I'll kind of end it there. But again, I can't really even think of a price where I'd want to get long Netflix, frankly. To me, they have to solve some issues. And, there are just so many things. There's so many names that are just so much more attractive that it's hard for me to stack it up. So I just think you have a lot of people kind of been thinking, hey, look how it's a great stock because the price hangs in there. Well, okay, so what happens when the price doesn't hang in there anymore? So, we'll see what happens, but I think people are very, very much underestimating the impact of losing the Disney library.
Yeah, and I also think that is a big deal. And again, that Disney launch is later this year in November, I believe. So that'll probably weigh in on this stock at least up until then. So a lot of headwinds that Netflix has. All right, why don't we jump into the cloud names, because actually one of our technicians highlighted SKYY as the proxy to take a look at these cloud stocks. So I'm just going to throw that one up there, and that it has been lagging a little bit over the course of the last couple of sessions at least. And I know you are somewhat bearish on the cloud space itself. As I look at this sitting here today, I know that you have some cracks. Why don't you reiterate some of those? And are they the most vulnerable in this earnings season?
Well, I mean, they could be. I mean, I could have said, roughly the same thing last quarter. Although, I didn't say to short many of them. If I don't know if I published that I would short any of them, any single name in front of the report last quarter. I'm not really sure I did. I just don't like the group. I think it's very dangerous. It's crazily valued. It's the most expensive it's the most expensive it's been since 99. And some of these stocks are, while not 99 crazy, they're in the realm of that. Again, Zoom top. Now this isn't forward sales. This is current sales. Like sometimes I talk current sales just because most people don't have my spreadsheet matrix, so they don't have access to all the data I have access to, which I put a ton of time and work into. But anybody can go to Yahoo Finance and look at the current price sales ratio. It's 67 on Zoom. Zoom topped at 72. Crowd, what's crowd sniffing here? 56. These are very, very heady type numbers. And so the main crack is just that trees don't grow to the sky. At some point growth will decelerate. The biggest issue I think, though, that the group has, again, is really just it's a combo of three things. It's a combo of the fact that money tends to trade very crowded now. So people love to kind of crowd in. Everybody likes to get on the same side of the boat because the trade's working, momentum. Everybody worships the price altar of momentum. The companies that garner the biggest increases in market cap then sort of tend to hold that market cap until things break. So, and it doesn't leave a lot of room. By the way, I do have a spec trade too, we should talk about later, but it doesn't leave a lot of room for cheap stocks. It doesn't leave a lot of room for money to roll into other things until the trend basically breaks. And so you kind of add all of it up together. Again, is money going into OKTA? Because OKTA is literally the best company in the world at what they do, and nobody can compete with them. And they have solutions which nobody else has, and they have a 10-year runway which is unassailable. Again, that was my thesis on Splunk and Workday and ServiceNow and a few other stocks, circa 2013-14. I viewed Workday had a basically an unassailable position in an area that they were going to dominate, and they have. OKTA's good. I mean, I loved OKTA when it was cheap, but I don't know if OKTA's Workday. I don't think Twilio's Workday. I don't think Zscaler's Workday or Splunk or CyberArk, by the way, for that matter. So anyway, we'll see what happens, but there's just so much money is chasing names for one reason, because they've gone up, because the chart's in the upper right corner. And so, again, hey, that looks glorious until the stocks gap down 30%. But you literally can't justify these deals. I mean, what do we see software M&A typically at? For old school growth, it's about 5.5 to 7.5 times sales. That might be forward sales. For slightly younger, higher durable growth, you kind of have 8.5 to 11 times sales. I think that's about where Red Hat was bought. That's a lot of where a lot of CRM deals go off at, 10, 11, 12 times forward sales. Again, they tend to buy younger, higher growing companies. Interestingly, you don't see much M&A for really, really new high growth companies. You just don't see much. And then, in fact, I can't remember the last deal where a company was a young, super, like in their hyper growth phase and got bought out. Maybe you see some of that in the private equity market. You don't tend to see that with publicly traded stocks. And I think because, people kind of know, hey, we'll just wait for the growth to slow, the price will get a lot cheaper. And so, but that's basically it. I mean, we could talk about why cloud stocks are dangerous for 5 hours. But in a nutshell, there's always comes a point. It's like, look, are the stocks going up because of just people that don't know anything are dumb enough to keep buying them at ever higher prices? Again, 99, spring of 2014. I mean, there's been lots of. I mean, hey, you could argue late last year, the FANG stocks were pretty much just going up because they were going up, and then all of a sudden, pretty much out of nowhere. I mean, there was nobody on the planet, I don't think, except me, that thought that FANG stocks had roughly 50% downside risk. And sure enough, in 6 weeks, they went down about 50%, a little less, but roughly 50%. So I think we are going to see that. I don't know when we're going to see that, but I think we are now in that realm where we have very high odds of several stocks dropping 50%. Might not happen this quarter, might take a few quarters, but at some point you get to a point where you either get, a bunch of stocks to drop 35 to 50%, or one or two or three stocks drop 50 to 80%. And you don't know which ones those are going to be. So, and if you're buying stocks and thinking, and hey, stops are great intraday, unless you have a trading halt. But if you have a gap down, you have a tight stop, you have a gap down, stop doesn't do anything against the gap down. I mean, you could have a 7% stop and you have a 30% gap down, you're not getting out at 7%. So anyway, you add all this together, I mean, just to me, you don't need a bunch of reasons. The fact that these things are the most expensive they've been since 1999, to me, that should be enough reason. And the thing is, for every OKTA, there's like 10 to 20 super cheap stocks that are trading as stupidly cheap as OKTA's trading stupidly expensive. So, just from an allocation of capital standpoint, yeah, you might not get instant gratification on those names. Maybe you have to hold an Infinera for a quarter or two. Maybe you have to buy it at a price, and maybe you have to eat 10 or 15%. But when cheap stocks hook and start going, they go big. And there's they don't just go 20, 30, 40%. Sometimes they go 100, 200, and 400%. All depends how extreme the downside move has been, and then how good the news gets that gets them moving in the right direction again. When I owned Twilio, it was a very maligned company, and it was very undervalued on growth. And we can look at how much Twilio's gone up. A little stock like Rubicon, RUBI. I can't remember my low cost on that, but I know I was buying some in the 250 range, probably even below 250. That was once kind of a semi-darling IPO. It was never a hot IPO, but it was well liked. Can't even remember what the highs were, maybe 30 or something. Rubicon hasn't had a hard time going from $1.50 or $2 to $7. I mean, so and arguably it's still a very cheap stock at $7, low sevens. So, you just have to see. I mean, at one time, one of my best trades, I think of like 2016 or 17, was buying Hortonworks between like 550 and 7. I can't, the chart's gone now, so I can't go back. But memory, I was buying that stock cheap. And people forget, I mean, this stock went to the low mid 20s a year before they got bought out. So, Hortonworks was a 3-bagger, plus, just because it got way too cheap. It wasn't like it wasn't like the results ever got hot. It was like just a few quarters weren't as good. It was like maybe people wanted 52% growth and they were doing 42% growth. But yeah, I was buying, I was buying Hortonworks again 2 years, 3 years before they got bought out. On big gap downs where they did 40, 45, 48% growth rates over prior year, but people didn't like the quarter. And so the stock went from like 12 to 7 or something, or 12 to 6. So, anyway, this is a very strange market. It's a market of extremes, and you tend to see that. The weirdest thing, and we talked about this last time, 99 in many ways, though, was a smarter market. It was a more rational market because at least you had upside pin action. So everything kind of was dumb together. So the dumb, really expensive hot stocks kind of pulled other stuff up. This market's just the opposite. It's like for every OKTA, the algos go and they beat on and punish, like I say, 10 or 20 stocks that trade at these super extreme, crazy low levels. And then if they have a bad quarter, which should be more than priced in, maybe it's priced in to the max, like maybe it's overly priced in. And if they miss again, the stocks drop another 20%. So you just see some crazy stuff. I mean, we were talking about MTSI and how excited I was to buy MTSI in the roughly mid-13s. Stock's $18.50 today. And by the way, MTSI really hasn't had any... I mean, they haven't had an earnings report that's good yet. They had the only real good news I can see on MTSI is you had the new CFO or CEO came in and bought quite a bit of stock in the low to mid 13s. And that's really been the only positive catalyst. Other than, again, valuation catalysts, some analyst upgrades. I think people are sniffing. People know how good their portfolio is, and if people know that, hey, look, we get clear of this China news, this thing could be a really hot stock. And they go from bad quarters to good quarters, and if this thing has good quarters, God, who knows how high it's going to go. But this has taken a little while, right? It did the thing I love most. It had bad news, and it didn't keep going down, right? That's the thing I always talk about. If you give me a stock that I already like, and then they have bad news, and the thing goes up instead of down, I'm buying it. I'm buying it unless I already own too much or already own enough of it. But anyway, I think we're going to see a lot of MTSIs, and I think we're going to see a lot of cloud stocks crack. I don't know if this is the quarter, but the Netflix the Netflix drop. And by the way, it's not like the Netflix quarter was terrible. Their U.S. subs were pretty terrible. But I mean, the raw numbers that Netflix delivered weren't terrible at all. Yeah, that stock's dropped a lot on a quarter that, again, on financial metrics isn't terrible. So we'll just have to see. But we are in a market that has very extreme conditions on both sides. And the longer conditions stay extreme, the more rapidly the odds of a rectification period come, a regression period come. So, it's basically, if I look at all these cloud stocks now, whether it's an old school cloud stock like Adobe or Intuit, or a new school cloud stock like an Okta or a CrowdStrike or something, guess what they all look like? They all look like AOIs to me when I was shorting AOI at 95. I called peak earnings on AOI. Analysts still really liked it. There were analyst upgrades, I think, just days before that stock had bad news. I think it was finally a bad quarter that broke that stock. But they loved that stock until they hated it. And so to me, the only difference is AOI is cyclical, software is not as cyclical, but that's what they all look like to me. They all look like a bunch of AOIs. Or they all look like a bunch of Teslas at $400. And, it didn't take much when Tesla finally started going down. It dropped 150 points awfully quick.
All right, so let's talk about Infinera, because to me that seems like the most comparable to MTSI as far as where upside is, and where you kind of label it as price stupidity, I would imagine. So does INFN fit that category?
Well, it definitely was. It still probably is. It'll be interesting to see if it becomes a chart, like a classic bottoming chart trade. It's kind of looking like that right now. I mean, here's the most interesting thing about Infinera, other than, again, how crazily stupid it got. And I'll talk about this in a couple different ways, but the most interesting thing is that they had a business. This whole move started, and the company did I think a 90-minute presentation. Well, there was literally, for anybody that knows the company at all, has done any due diligence, knows their product suite, and just kind of knows the company, there literally was nothing new in that presentation. I watched I'm not going to lie, I did not watch the whole thing because I frankly found it boring and repetitive, and there was nothing new in it for me. So I watched probably half of it. I watched like 45 minutes of it. I did go through the whole slide deck, though. Guess what? I've seen all those slides before. I've seen all those slides on data growth. I've seen all those slides from Del Oreo. I've seen all the slides at Infinera's technology. I've seen all the slides on PIC, right? Photonics Integrated Circuit, the benefits. Again, that's why I like the CASA. Versus older school photonics technology, blah, 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 blah. So there was nothing new, and yet the stock started going up the day they did that presentation. By the way, the first 5 minutes presentation, what do they say? They say, "Oh, we're in our quiet period. We're not updating any numbers." Then there were some people. I actually saw some people reporting like they thought numbers were guided higher, or they pre-announced the core. I mean, just ridiculous stuff, right? Again, this is people looking at price action, trying to find a reason for it, and making something up. There was nothing new in that presentation. Now, you could say, well, it was good that Infinera, with the stock being as low, didn't presentate. Well, companies do presentations every quarter, right? But again, this is one of those things it's almost like had they had bad news and the stock went up anyway. Put it this way, they offered nothing new, and the stock's been going up since. And then lo and behold, the stock's up about 30% off of lows, and we get an analyst upgrade. I mean, it's pretty typical, right? So, and by the way, I'm not making fun of the analyst. I mean, I would say it was a better upgrade at 280 than 350, but 350 might look like a really darn good upgrade if the stock goes, 50, 100, or 200 or 300% higher. So, I'd say it's better to upgrade it now than wait till 6. But I guarantee you this: there are going to be a lot more upgrades on Infinera if it goes to 6 than there ever was at 250 to 4. There will be very few upgrades under 450, most likely. There will be a lot more upgrades at 6, 7, 8, 9 than there would be at lows. And that's just the way things work. But I think I was very clear on my strategy on this. I don't love the name. I just started buying it with trading gains. I did pretty much since I think I bought some on that gap down last quarter. Because again, and by the way, last quarter was not a terrible quarter. The quarter itself was kind of ugly, but the company didn't lower full year guidance very much at all. In fact, they barely lowered full year guide. I think they lowered their full year guide by like 30 or 50 million or something. So they're rationalizing the Corient buy, which was a very good buy, but they probably bought a lot of very low margin stuff with the Corient buy. They only paid like 0.5 times sales for it. So I think it'll prove to be a very good buy. I think it'll prove to be highly synergistic. It increased I roughly doubled their revenue base, if I'm not mistaken. I think they'll be able to rationalize the Corient portfolio, keep the higher margin stuff, get rid of probably the worst. Could probably get rid of the bottom 20% of the product portfolio that's like break even / money losing business. And then, as I said, I think we were pretty much on the day either Acacia got bought out or the next day, but I think it was a day that Acacia got bought out. I thought it was very odd that Infinera had zero connection on Acacia getting bought out, because at this point Infinera is the last publicly traded company that basically has PIC technology and silicon photonics technology, and so we'll see what happens, but. I mean, the setup now is pretty easy. Could they have a bad report and go lower? Sure. But I think people are kind of smelling how much value there is in this thing now. Just the IP, again, with this thing, even at 360, it's probably only trading about 40-50% of like a legitimate M&A value. I would kind of put a worst case M&A value on this thing, like 650 to 8. That would be kind of a worst case like buyout that I would project for it. I'm not saying they're going to get bought out. That would just be like kind of a worst case. I think I've said that number many times. But the setup on this, the reason I was buying it and was willingly buying it kind of as I kept making trading gains and plenty of other things was that the setup on this one's one of the easier setups. I think all they have to do is just not miss and not materially guide down. Maybe they just don't even have to miss by much. But I think basically, if they report in line and guide in line, I think stocks goes up quite a bit. And I think that if they have anything good to say, they have plenty of business, plenty of new business, plenty of design win activity, they're in plenty of field trials right now with their new tech. If they start showing revenue transaction from field trial density, I think the stock could go up a lot. So, but really, I think for them just to hold and rise from current levels, I think they just don't need to miss. So that's a pretty decent earnings setup. And again, I mean, I'm not going to make it sound like hey, this is the greatest stock in the world, because I don't really like penny stocks. But to me, this is not really a penny stock. This is what I call an illegitimate penny stock. It's a stock that probably shouldn't be a penny stock, but just because of price action got into penny stock territory. Very similar to how I was buying, I told the story before, I was buying both Sienna and Finisar back in 2009, and guess what? They were penny stocks. They were I don't know, $1.50 to $4 somewhere in there. Those stocks, industry leaders in this industry, probably didn't deserve to be penny stocks, but they were, just due to negative price action. And so, this is a company that probably shouldn't be a penny stock, or just from a quality standpoint. I mean, they got almost $1 billion in revenue and whatnot. So, but yeah, I think the setup's relatively compelling. Like I said, it's not a make or break position for me. I don't own it near the size of plenty of other positions, but these are nice positions. You take, relatively small to mid-sized stakes and things like this. If you buy them, you get your cost decent. You buy them in the 3s or 4s, and if they go to $8 or they go to 12 or they go to 16, you end up with pretty nice score. So the last thing I'd say about this is it wasn't that long ago. This was a $12 stock. Was it mid-18, early 18? Yeah, early to mid-18, this is a $12 stock. And I'm going to tell you, I mean, this was not an overvalued stock at 12. It was not, Infinera was not a loved stock at 12. It was probably a loved stock in mid 2015 at 24. But it was definitely not a love stock at 12. So we'll just have to see. You know, they have to deliver though. I mean, for them to get the 12 plus, they can't keep, you know, missing quarter after quarter after quarter. At some point, the cycle's got to turn. But that's the beauty of this name. By the way, it kind of reminds me of a Micron, when Micron was either a $6 stock or lower in 2013, or a $10 stock or so, roughly 3 or 4 years ago. You know, sometimes people forget that cyclical companies are not secular companies. So what I mean by that is a cyclical company at the bottom of the cycle does look pretty bad. Like CASA is another one, you know, CASA. So you know, at the bottom of a respective cycle, numbers look terrible. By the way, AOI is probably bouncing along the bottom of their respective cycle right now. So at the bottom of the cycle, things look really bad. You know, and then people want to project those bad results out in perpetuity, when in fact, well, the bottom of the cycle probably doesn't last that long. Probably 3 quarters at most, 1 or 2 quarters is short-lived. And then once the cycle starts turning, whether it's a respective company cycle or it's industry cycle or both, all of a sudden, you know, numbers start getting better. And sometimes the company doesn't really have to do much. They just have to sell the products they sell, the upgrades they sell, and participate in an upcycle. And just like sometimes they can't do a whole lot to avoid the down cycle, because the down cycle is part of the cyclicality of the business that they're in. So anyway, but that's the beauty of cyclical tech, is that sometimes you don't really have to be a genius. You don't have to figure out, hey, is there something this company is doing that nobody else is doing, that nobody can reverse engineer, they have something special, blah, blah, blah. You don't have to figure out anything special. You just kind of have to say, look, are they basically the same company they've been? And is the cycle probably close to a low? And does it have a good probability of turning up? And when I was buying Micron at 10 on the way to a $40 stock or more, I just figured out that, look, people were really negative. It's basically the bottom of the cycle. The cycle is going to turn. I think Infinera is pretty similar. So you know, I think AOI is pretty similar. Again, I've said AOI is my least favorite stock in the fiber optic space. It remains that, but that doesn't mean I don't think I can make money in it. So anyway, just not to spend too much time on this, but I think that, you know, we're probably reached the point where, you know, the cycle is going to turn for Infinera. Results should start getting better. And again, I'd encourage everybody to listen to the call. There was actually a lot of positives in their last quarter call. Again, the results were not positive, but the guide, I thought the guide was pretty positive, yet nobody cared. Nobody seemed to care about the guide. And I'd say the same thing about CASA. The guide for CASA, and in fact, they did one different than Infinera lowered their full year guide a little. I don't think CASA lowered their full year guide at all. So again, rough current quarter, but they kept the full year guide, I think, where it was the prior quarter. And again, nobody seemed to care. They killed the stock anyway. And again, I think just the algorithmic activity. Dearth of buyers, it's easy to raid these things, blah, blah, blah. No uptick rule. We've talked about that 100 times. You know, you can short a company with debt to effectively zero if nobody's out there defending it. You know, again, we have these market structure problems that create these great opportunities, frankly. So, but yeah, I think there's several stocks. I mean, CommScope is probably in a similar deal. CommScope might be a little weird though. Just it's almost like there's so few people that I think of that are aware of how big Comm's revenue base is relative to the market cap. So we'll see. Same thing. But if they miss, the stock probably does go lower before it eventually goes back up. But you know, again, there's just some weird stuff. There's just some very weird mispriced stuff. Again, why did Acacia trade to 45 before they got bought out at 70? That's kind of weird. You know, why did Acacia even go down on the Huawei blacklist when they had 1% exposure to Huawei? That's kind of weird. You know, you just have to, you just have to kind of look at the stuff for what it is. I mean, some stuff is kind of, I'm not afraid to call it manipulation. I think there's a lot of manipulation in the marketplace. So you have to be able to trade around it and hopefully take advantage of it where you can.
All right, so another stock that falls in that same wheelhouse of Huawei and some of the Chinese 5G plays is IQ, and this really does look like one of those stocks that is setting up right for a turn to the upside. What's your overall takeaway in IQ?
Well, yeah, the chart looks interesting. It kind of had it had a big move early this year, had a big check back, but didn't really challenge lows. But IQ was basically created by not basically it was created by Baidu. Baidu owns somewhere between 50 and 60% of the company. It's the Netflix of China. Unlike U.S. Netflix, I don't get the sense that IQ is overpaying for content. I also get the sense that their audience can be massively larger than the Netflix audience will ever be. And again, I think it's basically a mispriced stock, and it's probably low just because of price trend activity. Fundamentals are good, growth is good. So hey, you don't have to like Baidu, and you don't have to like some other Chinese stocks, but I do think in general, I have worked to increase my Chinese exposure. This is one of the names I've added, and the reason is because, well, I don't want just Baidu for my China exposure. At the same time, I don't want to own a bunch of Chinese stocks. Now you can say, well, wait, if you have Baidu, you don't really need IQ. Well, sometimes you got to learn from your own mistakes. So I owned Sina a few years ago and did very well on it. And Sina, one of the biggest assets that Sina had was Weibo, WB. And so I had some little WB, but I mostly had Sina, and my whole, it was like a backdoor play to get Weibo. Well, had I owned both, I would have made more money. So Sina did very well, ended up going 2x pretty easily. In fact, it went more than that, but I think I probably got about a 2x move on it personally. I think it went about 3x actually on the total move from this is 15 to 17, 18. WB went from basically 10 to 100 and something. So sometimes it doesn't hurt to own the underlying asset, because the underlying asset being the higher grower or the higher growth asset might do well, and the parent isn't going to capture the whole move of the underlying asset. So in this case, I'm sort of learning, in other words, I should have owned WB and Sina before. And the one thing I did like about Sina, though, back then, that's SINA, is literally, it's like it is now. It was literally trading for a discount to net assets and cash. So it wasn't even trading at 1 times net cash. It was basically trading like 0.65 or 0.7 times net cash and investments. And so, that was kind of the whole thing. I don't necessarily love owning a lot of China exposure, but if I own it, I usually have a very strong fundamental reason to do so. And I was basically getting Sina for less than the value on the balance sheet. So that was pretty compelling to me. And I think IQ is fine. I think it has a long growth runway. And I'm choosing basically to own both the parent and the underlying asset in this case. Very cheap stock on growth. I mean, if I don't even know, you can't even really do a comparison, but if you were to do a comparison of like IQ to I don't know, like an OKTA, I mean, you got roughly similar growth, similar year over year growth. I don't know. What's the discount? Is it 85%? Is it 90? Is it 96%? I mean, it's some astronomical discount, right? Now, you're always going to get a discount because it's Chinese growth. It's not software, but still, so companies with similar growth rates, should sort of act somewhat alike. I mean, that was part of a pretty easy trade I've made on Stein, by the way. I was a buyer of Stein in like the low to mid 20s. Stein's worked nicely higher. Stein has in fact, Stein has a higher growth rate than many of these cloud names. And I won at 24, 25-ish. I believe I wrote something up like that the discount, the Stein discount to pretty much the cloud space is laughably large. I still like Stein. It's going to be a stock move around a lot, but I think as long as they hold on to a certain amount of the growth, I think there's quite a bit of runway. So there's just tons of these in this market right now. I might even mention Bloom. Again, we talked about Bloom. I mean, Bloom had really good news. That news, that the Duke Energy news they had was very good. Stock's been down quite a few days in a row. Again, the stock doesn't really trade on its news. It just sort of trades on flow. And if there's no buyers, I guess it's just going to get rated lower until they have some really nice material catalyst, which makes the stock go up, possibly massively. So again, we're just in this very weird market. There's tons of mispriced assets, both on the high side and on the low side. I mean, we literally could talk for 3 days and not mention them all.
All right, and then we do got to touch on some earnings, at least some previews, and probably the most, probably one of the more animated stocks that our listening community follows with you is Twitter, and they come on Friday. So let's get your thoughts on Twitter.
Yeah, and then we could rifle through a bunch of these like in rapid fire fashion. But yeah, Twitter, I might hedge a little bit of it this quarter. And almost not because I'm worried about it. Just it's almost like a gift to the trading gods. Here's the thing. I do think one thing I don't like. I don't like when I see an abundance of aggressive sort of option positioning ahead of a quarter. A lot of people think that's bullish. Statistically, it's actually not. It's actually bearish. Just like same thing when you see lots of bearish activity in a stock ahead of a quarter. Statistically, that's bullish. So anyway, that's the only thing that's actually kind of making me nervous. So the stock's, again, not that expensive. In some ways, it's kind of had a quiet move into this quarter. It seems like Snap has garnered a lot of attention. I'll talk about a trading idea I have in Snap, by the way. Generally Twitter tends to act well when a FANG name or two doesn't. So the fact that Netflix is down is mildly positive for Twitter. Again, this is some wonky stuff, but there's some pretty good statistical evidence. Again, Twitter's kind of a contra stock. Sometimes it gets, in other words, if everybody's piling into FANG, Twitter tends not to do that well. If there's some cracks in FANG or some cracks in some other stuff, there's room for people, that leaves room for Twitter's market cap to go up and expand quite a bit. I think, from a structural standpoint, I think there's going to be a lot of positioning for Twitter as a short-term play. Sometimes that's dangerous too. I think Twitter is a better investment than it's a great trading stock for me personally, but some people have a hard time trading it. But, I think sometimes, right, I guess here's what I'd say. I kind of call the quarter a 50-50. I think ahead of last quarter I was actually really bullish, but the price was quite a bit lower heading into last quarter. Price is higher. Again, I think there's quite a bit of bullish option flow, which I actually don't like. So we'll just see what happens. I might hedge it. I might just do kind of a cheapy hedge, maybe some kind of spread, something that's cheap, maybe gives me 4 points of coverage or something. I don't think there's going to be a big downside move, and I think it'd be bought relatively quickly, like within a couple weeks. So I don't know. We'll see. I actually, but like I said, I wouldn't be. The one thing I would not be doing. I'd love to see this happen, but I would not be buying like aggressive upside calls because that's what it just seems like a lot of people are doing, and that's just a setup for the market makers to basically take that call premium to zero and get paid on it. So I don't know, kind of edgy on that. As far as Snap. Snap has had so much positive analyst comments. You would think, and it probably odds are that Snap does work a little bit higher. But I would say like the question I have from option positioning is how much upside juice is left. So in other words, sometimes it's better to take the opposite trade, even though it's a lower odds trade, because the payout would be very high. So my view on if Snap does go down, it'll go down a lot. Or a lot more. Well, nobody's even expecting it to go down. So any move down could be very much exacerbated. So I might do some Snap puts. Again, my probability would be that the odds of getting paid out are relatively low. But if they work, this is like a poker. It's like a smart poker bet. Like sometimes you got to do it. You got to play a hand that the odds aren't great, but if the payout's huge. And that's kind of what I think the setup is on Snap. So, if you're bullish on it, you go up, okay, so maybe it goes up a little bit more. If it does go down, I think the downside is way more than people expect. So, we'll just see what happens. Visa is another dangerous stock. Again, seems like a grinder. Everybody thinks Visa's safe. I don't know. I don't know if at 180 it's that safe. I mean, this is kind of the chart's kind of parabolic long term. So there's another one that what would it really take to get the stock to go up a lot from here? Texas Instruments is another one. Can't say I'm very excited about. Again, kind of a loved company. Facebook is another one. I'm hearing that there's been a very, very aggressive call buy on Facebook as well. Again, a lot of people think that's bullish. I don't. In my view, I don't think that's bullish. PayPal is a stock that I used to own. I don't know, $39-40. And if it ever does come down sharply again, I think last year PayPal set up as a pretty good buy. This is more of a plotter. I don't know if this is really a dangerous one. This is one of the few stocks I would say kind of deserves to be where it is, frankly. Stock really hasn't gone up given how good the results are. Fundamentally, this is not. It's kind of like a Google. It kind of looks expensive because the market cap's big. But, on a lot of metrics, it really it is not too expensive. ServiceNow is another cloud stock I'm going to be watching. That's tomorrow. Again, I'm just not, the stock's gone up so much, just not sure what's going to take to keep it going. Xilinx had I think I was warning about Xilinx last quarter when it was a $140 stock. They got hit very hard last quarter. Stock went down 50 points. I don't know. That's probably a 50-50 quarter now, but I'm, not really interested in the long side on it. Cadence just had earnings last night. Sister company. Results definitely were not great. Stocks bounced kind of off of lows, but that's another expensive chip stock. So, there's not a whole lot. We'll talk about Thursday, or I'll maybe do a post on Thursday. Same thing, a lot of setups. I'm just kind of waiting for setups right now. I'm not really seeing a lot of stuff that I really love from the print, except unless they're a really cheap name or unless they get rocked on the print. But yeah, I mean, we'll just see what happens. I would point people though to like Netflix. Again, Cadence isn't surging. There was another stock that had Microsoft. I mean, Microsoft. Same deal. I mean, everyone in the world seems to love Microsoft, $1 trillion market cap. I don't know if they could have reported a better quarter than they did. Stock really hasn't gone up. It might be up $1 from the night of the report, but Microsoft hasn't made any material headway off that report. So we'll see what happens. Like I said, I think we're in this dangerous kind of point where it's going to take a lot. It's going to take a lot for stocks like Visa and Texas Instruments and Facebook and ServiceNow to materially move higher from current levels, and so that opens up the door for potential downside if things aren't kind of quote unquote perfect.
All right, I think that gives us enough to chew on for the week. TECHT, as always, thanks for joining me, and we will touch base next week, same time.
You bet. Always good talking to you.
You too. Thank you so much.
Bye.